Tuesday, January 28th, 2026, 6:34 a.m. Eastern Time. Asian markets opened with the Nikkei down 1,947 points. European markets followed with the DAX collapsing 2,234 points. By the time New York opened, global financial markets had already lost $8 trillion in value, but the visible destruction was just the beginning. Hidden beneath the market apocalypse, something unprecedented began. A silent bank rush that could destroy the entire global banking system without a single depositor standing in line. This is not about market correction. This is not about economic cycles. This is about systematic confidence annihilation triggering institutional capital flight at a scale and velocity that modern banking infrastructure cannot survive. And the mathematics are catastrophic. Let me show you exactly what happened on Tuesday. Let me walk you through the mechanics of algorithmic bank rushes. And let me explain why current banking safeguards have proven completely useless against confidence collapse that moves at quantum computational speed. Because when you understand the algorithms, when you see the capital flows, when you recognize the pattern, you realize this is not a temporary crisis. This is systematic banking system failure expressing itself through channels that operate faster than human comprehension. The visible crash was just the symptom. The invisible bank rush is the disease. Every modern financial crisis follows identical mathematical progression. Initial shock, algorithmic amplification, institutional repositioning, systematic breakdown. Tuesday's $8 trillion loss was algorithmic amplification of Monday's initial shock. Institutional repositioning is happening right now through quantum speed capital transfers. Systematic breakdown is mathematical certainty. The catalyst was derivative unwinding at 3:47 a.m. London time. Credit default swap positions began liquidating simultaneously across European banking systems. Within nanoseconds, algorithmic trading systems detected counterparty risk spikes and initiated emergency protocols. Automated sell orders flooded global exchanges faster than circuit breakers could respond. Nikkei fell 1,847 points in the first 30 minutes. Hang Seng dropped 2,134 points. FTSE collapsed 1,456 points. DAX lost 2,234 points. When New York opened, automated systems had already processed the Asian and European carnage. Dow Jones opened down 1,247 points. S&P 500 gapped down 634 points. Nasdaq plunged 1,892 points. But these visible losses were microscopic compared to the invisible crisis beginning in overnight funding markets, institutional deposit systems, and algorithmic risk management protocols operating behind normal market functions. Overnight funding markets provide continuous liquidity for global banking operations. Banks borrow from each other every second through automated systems that never sleep. On Tuesday, overnight rates spiked from 3.4% to 47.8% within 2 hours. This signals complete institutional panic. Banks were paying crisis premiums just to access basic operational funding. Institutional money market funds, which provide automated short-term lending to banks, began systematic credit line withdrawals. Prime institutional funds reduced bank exposure by 89% on Tuesday morning alone. Government-only funds saw inflows of $267 billion in 4 hours. Corporate treasuries were algorithmically fleeing from bank obligations toward government securities. But the most dangerous development was institutional deposit flight. Traditional bank rushes involve customers physically withdrawing cash. Modern bank rushes happen algorithmically. High-frequency wire transfers, automated clearinghouse movements, algorithmic payment systems. No visible panic, no dramatic media coverage. Just massive capital flight happening through computational systems operating faster than human awareness. Tuesday's institutional deposit outflows exceeded every previous financial crisis combined. Federal Reserve real-time payment systems processed $4.7 trillion in institutional bank-to-bank transfers. Normal daily volume, 450 billion. The system was handling 10 times normal traffic as algorithms moved deposits away from vulnerable institutions. Major banks lost 1.2 trillion in institutional deposits on Tuesday morning. Regional banks lost 456 billion. International banks lost 789 billion. Credit unions gained 123 billion as some algorithms sought smaller distributed institutions. But the critical measurement was algorithmic international flows. 834 billion moved from American banking systems to foreign institutions in 18 hours. This represents the fastest institutional capital migration in financial history. And the algorithms accelerated Wednesday and Thursday and continue operating as risk management systems, reassess counterparty exposure in real time. The mathematics are unforgiving because modern banking operates on fractional algorithms. Banks maintain approximately 11% of deposits as liquid reserves. The remaining 89% is algorithmically allocated to longer-term investments and lending protocols. This works perfectly until depositors' algorithms want capital back simultaneously. When 25% of deposits leave algorithmically, banks face liquidity crisis. When 35% leave, banks become mathematically insolvent. When 45% leave, banks fail regardless of government intervention. Tuesday's outflows represent 43% of global banking system deposits moving algorithmically within 96 hours. Government response was immediate but algorithmically inadequate. Federal Reserve announced unlimited quantitative easing. European Central Bank activated emergency asset purchases. Bank of Japan implemented negative interest rates. Treasury guaranteed global banking system stability, but algorithmic confidence, once broken, cannot be restored through human policy announcements. Institutional algorithms don't respond to government guarantees when mathematical analysis suggests systematic insolvency. Sovereign wealth fund algorithms don't process political promises when quantitative models indicate counterparty default probability. Corporate treasury algorithms move first, analyze later. The silent bank rush accelerated through channels invisible to traditional human monitoring. Corporate cash management algorithms automatically triggered when counterparty risk calculations exceeded predetermined parameters. Pension fund algorithms executed liquidity preservation protocols. Insurance company algorithms activated capital protection strategies. These institutional movements happen without human intervention or awareness. Quantum computing systems analyze banking financial ratios continuously. When algorithmic metrics exceed risk thresholds, systems automatically initiate deposit transfers. No meetings, no human decisions, no warnings. Just algorithmic capital movement at quantum computational speed. 7 major banks failed Wednesday. JP Morgan Chase, Bank of America, Wells Fargo, Goldman Sachs, Morgan Stanley, Citibank, and BNP Paribas were seized by regulators when algorithmic deposit outflows exceeded 67% of total deposits. These failures triggered additional algorithmic selling across global bank equity markets and accelerated deposit flight from remaining institutions. Global banks suffered identical algorithmic pressure with less regulatory protection. Deutsche Bank lost $234 billion in deposits Wednesday through algorithmic withdrawal. Credit Suisse faced complete algorithmic deposit flight and required emergency Swiss intervention. HSBC, Barclays, and Royal Bank of Scotland activated UK crisis protocols simultaneously. The contagion spread through interconnected algorithmic funding markets that operate faster than human awareness. Banks borrow from each other continuously through automated systems. When algorithmic confidence breaks, these systems freeze. Banks algorithmically hoard liquidity. Algorithmic credit creation stops. Economic activity slows instantly. Corporate credit facilities were suspended algorithmically Wednesday as banks preserved capital through automated protocols. Consumer lending applications were rejected systematically by algorithmic screening. Mortgage origination paused at institutions using algorithmic risk assessment. Credit card limits were reduced automatically across the system. The algorithmic credit creation mechanism that drives economic growth simply stopped functioning. But the most catastrophic development was international dollar funding algorithm failure. Foreign banks rely on algorithmic dollar wholesale funding to support global operations. American banks provide this funding through automated interbank channels. When American banks face algorithmic deposit stress, international dollar liquidity evaporates algorithmically. European banks couldn't access dollar funding through any algorithmic channel Wednesday. Asian banks faced identical algorithmic constraints Thursday. Central bank swap agreements provided some relief, but not at algorithmic scale needed to maintain automated business operations. Global dollar shortage began affecting algorithmic trade finance, algorithmic commodity markets, and emerging market currency algorithms. This is how modern financial crises propagate algorithmically, not through human bank rushes, but through algorithmic funding mechanisms that connect global banking systems instantaneously. When one algorithmic component fails, the entire network experiences systematic stress. The Federal Reserve algorithmic response revealed the system's fundamental vulnerability. Unlimited liquidity algorithms can provide digital cash to banks, but cannot restore algorithmic confidence. Deposit insurance can protect human savers, but cannot prevent algorithmic flight. Emergency lending algorithms can keep banks technically solvent, but cannot force algorithms to maintain deposits. Central bank algorithmic intervention works when algorithmic confidence remains intact. Central bank intervention fails when algorithmic confidence collapses completely. Tuesday's crash destroyed algorithmic confidence in ways that human policy tools cannot repair. Market algorithms understand this dynamic. That's why algorithmic deposit flight accelerated despite government guarantees. That's why algorithmic repo rates remained elevated despite Fed liquidity provision. That's why algorithmic credit markets stayed frozen despite emergency interventions. The silent bank rush continues because the fundamental algorithmic problem hasn't been solved. Banks remain algorithmically overleveraged. Deposits remain algorithmically uninsured above certain limits. Institutional algorithms remain rational actors that prioritize algorithmic capital preservation over system stability. Traditional bank rushes ended when humans saw neighbors successfully withdrawing cash. Modern bank rushes end when institutional algorithms determine that algorithmic counterparty risk has returned to acceptable parameters. This algorithmic process takes time that vulnerable banks may not survive. Regional bank algorithmic failures accelerated Friday as deposit outflows reached 56% of system-wide deposits. First Republic Bank, Silicon Valley Bank, Signature Bank, and Republic First Bank were seized by regulators when algorithmic overnight funding markets refused liquidity provision at any algorithmic price. Each algorithmic failure triggered additional institutional repositioning. Pension fund algorithms updated banking exposure limits. Corporate treasury algorithms implemented enhanced counterparty diversification. Money market fund algorithms reduced bank commercial paper holdings. Insurance company algorithms sold bank bonds systematically. These institutional algorithmic adjustments happened gradually but persistently. Unlike human depositors who might panic and return, institutional algorithms make systematic changes that become permanently embedded in risk management protocols. When corporate algorithms update banking exposure policies, those algorithmic changes remain active indefinitely. The economic damage cascades through multiple algorithmic channels simultaneously. Algorithmic bank lending contraction reduces business investment automatically. Algorithmic credit availability restrictions slow consumer spending systematically. International algorithmic funding stress affects global trade automatically. Algorithmic equity market losses reduce household wealth instantly. Manufacturing algorithms released Friday showed immediate impact. Business confidence algorithms dropped to recession parameters. Capital expenditure algorithms were suspended pending credit market algorithmic normalization. Employment algorithms turned negative as companies preserved cash rather than expanding operations algorithmically. Consumer spending algorithms revealed similar deterioration. Retail sales fell 23% week over week as algorithmic credit access restrictions limited purchasing power automatically. Auto sales stopped completely at dealerships unable to provide algorithmic financing. Housing market algorithms ceased functioning as mortgage availability disappeared algorithmically. The algorithmic feedback loop becomes self-reinforcing. Economic weakness increases algorithmic bank loan losses. Higher algorithmic loan losses accelerate deposit flight automatically. Algorithmic deposit flight forces additional lending contraction. Algorithmic lending contraction worsens economic weakness systematically. International algorithmic implications multiply domestic effects exponentially. Dollar shortage affects global algorithmic trade financing. Reduced American algorithmic bank lending impacts foreign borrowers automatically. European algorithmic bank stress creates additional global liquidity pressure systematically. Emerging markets face algorithmic capital flight and currency pressure. This is how modern financial crises become global algorithmically. Interconnected algorithmic funding markets transmit stress internationally, faster than human policy responses can contain domestic problems. Local algorithmic banking stress becomes global financial crisis through mechanisms operating faster than human comprehension. The silent bank rush represents evolutionary advancement in financial crisis dynamics. Algorithmic technology enables institutional deposit flight at unprecedented computational speed. Global algorithmic interconnection amplifies local stress internationally instantaneously. Modern algorithmic banking leverage creates vulnerability to confidence shocks that previous human banking systems could survive. Government tools designed for human crisis types prove inadequate for algorithmic crisis dynamics. Deposit insurance protects human savers, but cannot prevent algorithmic flight. Central bank algorithms help solvent banks, but cannot restore confidence to algorithmically insolvent institutions. Regulatory seizure resolves failed banks, but triggers additional systematic algorithmic stress. The algorithmic mathematical trajectory is clear. Banking system algorithmic deposit losses exceed historical precedents exponentially. Government algorithmic intervention capacity appears insufficient for crisis scale. International algorithmic contagion effects amplify domestic problems systematically. Economic damage accelerates through multiple algorithmic feedback loops. This is not speculation about potential future algorithmic problems. This is analysis of current algorithmic conditions that reveal systematic banking vulnerability to algorithmic confidence destruction events. Tuesday's crash demonstrated the algorithmic trigger mechanism. The silent bank rush demonstrates the algorithmic transmission mechanism. Economic deterioration demonstrates the ultimate algorithmic consequences. The pattern repeats across financial history with algorithmic technological adaptation. Bank rushes happen differently, but algorithmically identically. Algorithmic confidence destruction propagates faster, but follows familiar mathematical pathways. Government responses scale larger, but remain fundamentally limited by political and economic constraints, operating slower than algorithmic systems. Modern banking optimized for algorithmic efficiency during stable conditions created vulnerability during algorithmically unstable conditions. Algorithmic fractional reserves work until algorithms question bank solvency. Interconnected algorithmic funding works until algorithmic counterparty confidence disappears. Just-in-time algorithmic liquidity works until stress demands exceed algorithmic system capacity. The $8 trillion crash was the algorithmic stress test. The silent bank rush is the algorithmic system failure. The economic contraction is the ultimate algorithmic cost. And the mathematical reality suggests this algorithmic process continues until algorithmic confidence stabilizes or banking systems restructure completely around new algorithmic frameworks. Tuesday, panic-triggered systematic algorithmic change that cannot be reversed through human policy intervention alone. The silent bank rush reflects rational algorithmic institutional behavior that will continue until underlying algorithmic bank vulnerabilities are resolved. Market confidence returns when algorithmic mathematical reality supports confidence rather than destroying it systematically through computational mechanisms operating beyond human control or comprehension. The algorithmic mathematical trajectory is irreversible. Banking systems worldwide have entered crisis mode that operates faster than regulatory response mechanisms. Institutional algorithms continue processing risk calculations that force additional capital migration regardless of government intervention. This represents fundamental transformation of financial crisis dynamics. Previous crises operated at human speed with human decision-making timelines. Current crisis operates at algorithmic speed with computational decision-making, processing thousands of assessments per second across global markets. The silent bank rush will continue until algorithmic confidence parameters stabilize or banking systems implement new frameworks designed for computational speed crisis management. Traditional crisis response tools prove inadequate against algorithmic mechanisms operating beyond human intervention timescales. Wednesday morning, Asian markets opened with algorithmic selling protocols active. Institutional algorithms processed Tuesday's data overnight and implemented risk reduction strategies. The computational cascade continues systematically, regardless of human crisis management attempts. Central banks discover monetary policy operates too slowly to contain algorithmic crisis dynamics. By the time policymakers analyze conditions and implement responses, algorithmic systems have processed information and adjusted positions. The mathematical conclusion is definitive. Modern banking cannot survive algorithmic confidence collapse, operating at speeds exceeding regulatory response capabilities. The silent bank rush represents crisis evolution that traditional frameworks cannot contain. The $8 trillion collapse was just the beginning. Now, algorithmic crisis mechanisms continue operating until mathematical stability returns, or system architecture transforms to accommodate computational speed risk management across networks. The silent bank rush represents financial crisis future. Algorithmic systems operating at quantum speeds create dynamics that frameworks cannot contain. Human decision-making becomes obsolete when algorithms process risk calculations in nanoseconds. Financial institutions discover algorithmic confidence collapse propagates faster than policy intervention. Trajectory suggests crisis continues until banking systems adapt to computational realities and implement quantum speed risk management protocols.